Live from Bloomberg's world headquarters in New York, I'm Scarlett Fu.
And I'm Tim Stanivek. Welcome to Bloomberg Crypto, a look at the people, transactions, and technology shaping the world of decentralized finance.
Here is what's at stake today. Stocks are under pressure, with Bitcoin not being spared in the pullback.
A rise in more suspicious trades connected to prediction markets as users try to anticipate every step in the U.S.-Iran negotiations. We're going to show you what Bloomberg News has found in the data.
And in just a moment, Strive CEO Matt Cole joins us as we discuss the price action in Bitcoin and the impact of that on digital asset treasuries, as well as digital credit.
That's all ahead on this hour edition of Bloomberg Crypto. First, though, we got to see where things stand. Bitcoin falling to an almost 2-week low as a sell-off in tech stocks hit risk assets. Year-to-date, Bitcoin still down close to 29%. Just today, it fell as much as 3.9% to 61,877. That's its lowest level going all the way back to June 10th. But the way you need to think about that is that's pretty much levels not seen since before President Trump was elected for a second term. U.S. spot Bitcoin ETFs have now shed nearly $9.4 billion in flows since October. It's not just Bitcoin, too, that's declining. Other tokens are lower as well. You see Ether right now down 4.3%, Solana down 5.3%, and you've got XRP down 2.8%, Scarlett.
And as Bitcoin's futures and all those other digital coins futures have declined, so too have shares of digital asset treasury companies. Strategy, 21 Capital, and Nakamoto are all down by at least 70% over the past 12 months. Nakamoto is actually sitting at a 52-week low today. It was trading at $679 exactly 1 year ago today. Tim?
Well, SPAC-backed digital asset treasury companies, or DATs, are facing growing scrutiny after a $1 billion deal between the crypto manager Reserve One and a SPAC collapsed on investor pushback. DATs that successfully used a SPAC to go public are also seeing shares plunge, like Avalanche Treasury, which is down 92% since its April debut. Bloomberg's Maria Clara Cobo joins us now for more. Maria Clara, good to have you on the program. Welcome back to New York. It's good to have you here. What is going on with some of these digital asset treasury companies? Because it's more than just being tied to price, right?
You're right, Tim. There's a lot going on right now. This strategy really became popular when Michael Saylor pioneered this strategy to buy Bitcoin to grow the balance sheet of his companies. And that proved really successful because the price of Bitcoin was skyrocketing at the moment. But right now, yeah, Bitcoin is undergoing a sell-off. Prices have dropped more than 50%. So investors are really questioning the validity of that strategy. They're prioritizing making a profit rather than investing in risky assets. So yeah, that's basically what's happening right now.
It sounds like the DAT trade stopped working when Bitcoin stopped going up. Do any of these companies, these digital asset treasury companies, have an underlying business beyond owning tokens and holding them?
You know, that's an excellent question, and I really think they should, because Bitcoin is, as we've seen, a really risky asset. So it wouldn't make sense for them to rely solely on Bitcoin, given that its price has fallen dramatically over the past few years. So I would certainly hope that they do.
We're going to speak in just a few minutes to Matt Cole, CEO over at Strive, and talk more about these digital asset treasury companies. Before we do that, though, are we seeing a shakeout in terms of like the survivors, the ones that don't end up actually lasting? Is that what is happening right now?
That's an excellent question, and I wouldn't say there's a shakeout. I wouldn't say that this strategy will completely vanish, but it really depends on what happens with the markets. I think we should keep an eye on that. I think we should keep an eye on the price of Bitcoin. I've followed the markets for a little over 2 years now, and this sell-off has really extended way beyond people's expectations.
Yeah, maybe we don't call it a crypto winter anymore. It's crypto winter into summer.
Yeah, it's an extended winter. It's the opposite of global warming. At least in the Bitcoin world.
We'll see how long it goes on.
Maria Clara Cobo, thank you so much for joining us. Normally in Mexico City, but here with us in New York, and we welcome her back to the newsroom. All right, let's stick with DATs, because Matt Cole is the CEO of Strive. It's a digital asset treasury company. And when he joined us in December, he said there were too many DATs. Matt is back with us now. So Matt, I want to put to you the question that Tim just asked Maria Clara. Are we in a period where we're seeing a shakeout of the digital asset treasury space, where you've got some survivors and everyone else kind of needs to figure out what their purpose is?
Yeah, it is still early days for the overall, what you call DAT ecosystem. Most importantly, I do think it's working in the instances of both Strategy and Strive. And you might say, how is it working? Your stocks are underperforming Bitcoin. And I would say that is by design. That is a feature, not a bug. Our common equities are designed to amplify Bitcoin exposure. Right now, you mentioned Bitcoin's at $62,000. That is literally at the 200-week moving average, which historically has marked near the end of a Bitcoin bear market. I think the underlying fundamentals of Bitcoin are strong, probably never been stronger. And so amplified Bitcoin exposure is great. Strive has been buying Bitcoin hand over fist in the midst of this bear market. You have up here, we have almost 20,000 Bitcoin. Remember, last fall, we had 5,000 Bitcoin. We've almost 4x'd our Bitcoin's holdings. Our digital credit product is working really well, and I'm looking forward to probably talking about that with you also today.
Yeah, we're going to talk about that in a few minutes. Before we get to that, though, Matt, more on the bigger picture, because Treasury companies, Bitcoin Treasury companies, have lost around $62 billion in market cap going back to October of last year. That's when we saw the peak, at least in this cycle, for Bitcoin. Reserve One, we just spoke about it just now, down 90%. You've said consolidation is coming. Only a handful survive. Are you the consolidator, or could you be consolidated?
So I think it's almost impossible to imagine us being consolidated right now. Our strategy is working really well. When it comes to some of the other players, I've been out publicly saying I don't think Strive is likely to be a consolidator. And the reason is that our strategy is actually working so well. In the last month, we've announced Bitcoin buys on single weeks of over 2,000, over 1,000 this last week, over 700. You combine that and you're getting close to $4,000 to $5,000 Bitcoin buys in just a month. Look down the list of Bitcoin treasury companies and how many Bitcoin they own. Our own strategy is working faster than accumulation could do. And so while I do still think that Bitcoin treasury companies teaming up would make for stronger instances, I don't think that Strive needs to be a consolidator at this moment.
Okay, how many of the companies in the digital asset treasury landscape are dead men walking then at this point?
Dead man walking is probably too strong of a term, but have not proven a sustainable strategy. I would agree with that assessment of the broader ecosystem. And so whether they go down the route of an operating company, which is what you're seeing with Jack Mallers in 21 and still in the early days of building that out, or whether you're seeing a pure play amplified Bitcoin digital credit company with like Strategy and Strive, you have a few more players in the international markets that are looking to do similar. I think it's still early. So I think that a few of them will likely age poorly. I think a few of them will figure it out. And obviously it's never easy when you start a new industry of an explosion of Bitcoin treasury companies right into a Bitcoin bear market. But I think that will separate the strongest from the weakest, and kind of gets back to the point of Strive. I mean, we 4x'd our Bitcoin holdings in the midst of it operating in a Bitcoin bear market. To me, that's strength. I look forward to see what we can do in a bull market.
Matt, I want to talk about credit. As we were, sort of teasing earlier, you argue that digital credit represents the next biggest story in Bitcoin. What is that story, and why is it such an opportunity?
Yeah, it's really simple. So right now we live in a fiat-denominated world. The dollar is still the reserve currency of the world. My view and the view of several Bitcoiners is we're moving to a Bitcoin future. That future is likely to move towards there over the course of the next several decades. Digital credit provides a double-digit income based on Bitcoin risk. And it's a great time to talk about this because last week was the toughest week in the short history. Digital credit's only been around for a year, but the toughest week in the short history of digital credit. But even in the midst of that short history, the total returns for digital credit, so STRC from Strategy, SETA from Strive, STRC's total return since inception, if you bought it at 100, has been slightly negative. SETA's been positive in the midst of a 50% drawdown in Bitcoin. You compare that versus treasuries. Take TLT as an example, the largest treasury ETF. For the last 6 years, it's had a negative total return of about 25%, minus 4% on average per year. Digital credit's outperforming that in the midst of a massive Bitcoin bear market, and I think it's going to work, and I think it's going to be $1 trillion opportunity.
Well, you mentioned the toughest week that you've had in this really nascent asset class, I guess we can call it, only a year old. We're talking about STRC, Strategies Perpetual Preferred Stock, just hitting that record low at $89. If the market is stress testing digital credit right now, what makes SETA different from STRC?
Yeah, so they're very similar. There's two differences with SETA that I would highlight. First, SETA is the first listed security in U.S. capital markets history to pay a daily dividend. That is true innovation. Even money markets, as an example, they accrue interest. They pay about once a month. So paying a daily dividend substantially reduces the volatility. And then secondarily, Strive has been more stable in maintaining a cash reserve. So when we IPO'd SEDA in November, we started with a 12-month reserve. We now have an 18-month reserve in the midst of a bear market. And so we could literally do nothing until, I'll call it, the end of 2027, not have to sell a single Bitcoin. That is balance sheet strength, and it allows our common equity to underwrite in an appropriate risk manner a long amplified Bitcoin exposure. And so those are the two primary differences. But I think from the broader market's perspective, I think the risk of both of these is mispriced and the income opportunity is great.
Matt, let me ask you a basic question. What practical solutions does digital credit provide? How would companies use it? How would individuals use it?
So my view is income as a asset class is broken in the broader capital markets. We talked about TLT, how the returns of US Treasuries, I think, are fundamentally broken. Money markets as an example. Money markets don't even keep pace with the rate of fiat currency debasement, which is average 6 to 7% per year. And so the money is broken, the dollar is broken, and people are losing trust in income solutions. We had a 40-year bull run in US Treasuries from 1980 to 2020. That propped up fixed income returns. That is not going to be the case for the next 40 years. And so people need high income. We have a retirement crisis in this country. And so whether you're an income, whether you're an individual, whether you're a corporation, you need something that returns greater than the rate of fiat currency debasement and backed by a strong foundational asset. And that is what digital credit provides. And I think this stress test in the midst of a Bitcoin bear market, if you think about when Bitcoin comes out of a bear market, it's pretty obvious to me that the credit risk tied to Bitcoin will come down and that these will be very attractive securities for a lot of people and a lot of corporations.
I mean, you've said that digital credit will be bigger than spot ETFs, could become a $3 trillion market. The entire digital credit universe, though, is these two products, SEDA and STRC. How do you get from these two products to $3 trillion in assets?
So my view, just to be a little more precise there, I think the ETFs around Bitcoin are going to also expand drastically, but there is just such a massive need for income in this country and around the globe that credit markets are massive, and there's a reason for that. There's a reason that these are broken. So how do you get to that point? We're going to likely see several new issuers of digital credit instruments. We're going to see ones tied to the pound, one tied to the euro, one's tied to the yen. And then in the US capital markets, which is obviously the deepest capital markets in all of the world, you're going to see different risk return profiles. So some companies take less amplification, pay less yield. Strive's taken the opposite approach. We are very optimistic on Bitcoin's future, and so we're taking more amplification into our common equity, paying a higher yield on SEDA, and then backing that with a sustainable, well-communicated cash reserves. And so I think this could be really, really large. And so the fact that we've seen it explode to about $10 billion in the midst of a bear market, I think shows you what this could be in good times. And I think as it's in good times, as track records are developed, and I think these track records are developing very strongly, you're going to continue to see growth in digital credit.
Matt Cole, always good to check in with you. Come join us in New York sometime soon. We appreciate having you on the show. CEO of Strive joining us from Dallas. Well, coming up, the battle over perpetual futures heating up. CME Group is suing the CFTC and its chairman, Michael Selig. The details next. And to access all the latest data and news on crypto, check out CRYP Go on the terminal. This is Bloomberg.
The crypto perpetual futures market is growing quickly, but not everyone is happy about it. CME Group filed a lawsuit against the CFTC and its chairman, Michael Selig, alleging that he overrode congressional direction. According to the lawsuit, Selig, quote, circumvented the regulatory regime required for approving perpetual futures as a future product. Here to discuss now is Lindsay Lin, COO of Dragonfly, which is a crypto-focused global investment firm. Lindsay, good to speak with you.
Good to speak with you.
So you have been a lawyer in the crypto industry since 2017. So you understand this lawsuit from a legal perspective as well as an industry perspective. Can you help us make sense of it? From where you sit, what is the regulatory regime supposed to look like that CME argues the CFTC circumvented?
Yes. So from my perspective, this lawsuit is all about business. globally, perpetuals are the #1 method for trading crypto. And so if you look at CoinGecko in 2025, there were 87 trillion traded in volume in crypto perpetuals, whereas there's almost no activity in futures or other options, because perpetuals are the #1 method for crypto trading globally. And so CME probably sees this and feels threatened, right? When the CFTC on May 29 announced its order granting Kalshi its Bitcoin perpetual, and then issued its policy statement saying Regulation 40.3 is the way to get approval for new perpetuals, I'm sure CME felt, oh, perpetuals are coming to the US, true perpetuals, not just perpetual style futures. And they felt very threatened that this could impede on their growing repertoire of Bitcoin, Ether, XRP, futures, and options.
Is it fair to say that Dragonfly's portfolio companies would benefit from onshore perpetual futures?
So
we could fairly say that, right?
Yeah, so we have a few perp dexes in our portfolio, decentralized exchanges, like Variational, Lighter, Hello Trade. And I think from their perspective, they currently don't serve any US customers, but they eventually would like to onboard US customers. And they see this as step one, the CFTC's actions as step one of eventually being able to come onshore.
So aside from what you see in your portfolio companies, or what those portfolio companies see, the CFTC did approve Kalshi's BTC perp through a one-day self-certification process that CME calls a, quote, novel and complex product. Even if you think CME's motives are self-interested, do you think there's a legitimate concern that the CFTC did move too fast?
Yeah, I think the CFTC has discretion in how it wants to categorize novel products. I think when Dodd-Frank was passed, perpetuals didn't exist. And so it's very hard to say that the Dodd-Frank meant for perpetuals to be a swap. And so I think the CFTC saw that perpetuals had the style of a future. It has standardized contracts, it has centralized clearing, it has mark-to-market compensation. And so it saw that it acts like a perpetual, and it has the risks of a perpetual. And so it decides to treat it in the futures regime. It has the characteristics of a future. And so it decides to trade it in a futures regime, which makes most sense for the risk that it poses.
Okay.
Lindsay, thank you so much. Lindsay Lin is COO of Dragonfly. And just to note here, we have a statement here from the CFTC. They've said that rather than compete in the marketplace, the CME has decided to undertake lawfare against the agency and the Trump administration's pro-innovation agenda. Incumbents fear the future and having to compete on a level playing field. We look forward to addressing their claims and dismissing this frivolous lawsuit.
Well, coming up, former New York Governor Cuomo's next act is crypto. We're going to tell you about the new venture he's leading with the owner of the New York Stock Exchange. That's next. This is Bloomberg.
I'm Nora Melinda. Let's take a look at your midday movers. First up, a sell-off in big tech is dragging major indexes lower after a sharp drop in Korean chip makers spilled over into U.S. markets, raising fresh questions about the durability of the AI trade. Now, among the biggest movers, U.S. chip stocks are under pressure as investors rush to exit the sector. SanDisk and Micron are among some of the hardest hit, with Micron set to report earnings after the bell tomorrow. Elsewhere, cruise stocks are falling after Carnival's profit forecast fell short of expectations. The group was already trading lower before the results amid the broader market sell-off. And finally, SpaceX is rebounding after a 3-day rout wiped out more than $600 billion in market value from the newly public stock. Those are your midday movers. I'm Nora
She was
Melinda.
never in the rundown.
Let's get to the odds. It's an in-depth look at the booming growth of prediction markets. Since the beginning of the Iran war, polymarket bets on an Iran peace deal are fueling fresh insider trading fears. A Bloomberg analysis of several well-timed polymarket bets with outsized profits reveals that the risk of insider trading. Bloomberg's Denitsa Sekova has been reporting on the story. She joins us now. Denitsa, what's the analysis that Bloomberg News did to find what's actually happening on polymarket?
We looked at thousands of suspicious transactions, and it was focused on all the bets around the Iran conflict. So since it started till the very end, and we saw around 45 million of suspicious transactions that have been flagged. Commonalities between is like freshly created wallets, putting bets at very low odds that end up being very successful.
So that's the definition of suspicious, like newly created wallet, something with a very low odds, that sort of thing. And
that's the commonality. That's kind of the top three. There are like 8 different criteria we look at, and we use data during using Polysites. Which have been building this for a very long time. One most recent trade we saw is one that's actually connected with the ceasefire. We saw one wallet place wagers as low as 6% probability of ceasefire. It was a really big bet, and in the end, it benefited $400,000 in just one market. So we saw a lot of those kind of fresh, suspicious trades. And obviously, there have been quite a few prominent cases that have been investigated by the DOJ and CFTC, but many of them are happening in the US. So that raises the questions, obviously, with those international markets and military conflicts, what is happening in other countries and how are they involved in this?
So how are regulators, how are lawmakers responding to this?
So there is an interesting play here. We obviously have Kalshi in the US and we have Polymarket expanding in the US, but they have both trying to work with regulators. And part of that is that they have been reporting more and more cases to regulators. So a lot of the scrutiny we've seen lately is coming as more investigations have been found. Of course, there was this famous Maduro case where one account made $400,000, and that case is being investigated. But there was on Kalshi, there was George Santos betting on his own race. That is also being investigated. Of course, his comment is that this is not true. He's pushing back against the allegations, but it's just opening a new frontier where clearly there are consequences if you do that.
And with Santos, it was like a sort of a mention market, like will he appear somewhere, right?
Yeah, yeah. So the idea was that he said he's going to appear. Eventually, he didn't appear. But as he was saying he's going to appear, he was placing bets in the opposite side of the trade that ended up being quite profitable.
All right, interesting time, Scarlett.
Sometimes you can't make up these details.
No, you can't. You just got to predict them.
All right, Denitsa Tsekova, thank you so much. Bloomberg News cross-asset reporter Denitsa Tsekova. And coming up next on Bloomberg Crypto, we've got more on the odds as the World Cup has gone off to a hot start, not only for Team USA, but also for prediction markets. We've got all the details ahead. This is Bloomberg Crypto. Welcome back to Bloomberg Crypto. I'm Scarlett Fu alongside Tim Stenovic. You've been watching the World Cup matches, haven't you?
Yeah, I watched the USA game on Friday, watched some highlights of Argentina yesterday because that game was on during my show. Iran last night too, and France. Watched a little bit of that. Mostly my son is just interested in it, so like.
Okay,
yeah.
So you've got a genuine soccer fan watching the game, and then your dad, so you're watching it alongside with him. There are a lot of people, of course, watching because they've got money at stake here with prediction markets being a big component of this World Cup tournament. Yeah,
it's actually attracting more money to the fast-growing prediction market industry with over $5 billion traded across Polymarket and Kalshi. For more, let's bring in Yesha Yadav. She's professor and associate dean at Vanderbilt Law School. Also former legal counsel with the World Bank. It's interesting to see this at a time when prediction markets are just exploding in popularity and use, and so much of what's happening on prediction markets are sports related, coincide with, I mean, one of the biggest sporting events on the planet. Is it a make or break moment for these platforms?
Tim, Scarlett, thank you so much for having me. This is a supercharging moment for prediction markets. Tim, you mentioned at the outset just the sheer volumes that are happening. When you look at the Polymarket winner contract, just betting on who's going to be the winner, it's seen almost $3 billion worth traded on that contract alone. Kalshi, as you mentioned, has seen $6 billion worth of notional trading volume. When the World Cup began, its notional trading volume surged by almost 40% in that week. So in terms of just where we're going with this, presidential elections really brought prediction markets into the game. The game now, being football, is making prediction markets so incredibly mainstream. This is a deeply important moment for the prediction market industry. what happens from here on in just shows the incredible popular appeal of prediction markets, particularly as we're having a 39-day tournament where the volumes are likely to grow as the game goes on.
And Yesha, you are particularly troubled, dismayed by what you see as content creators who are college age, so really appealing to young people using dummy trades to promote trading to US-based investors. Walk us through what you've seen and why this is so problematic.
Well, one of the big appeals of prediction markets has always been this incredible transparency, the ability of people to bring their information into the fore, like being able to sort of put their perspectives into the prediction market to be able to get a real sense of insight as to what the probabilities on a particular outcome are likely to be. Now, Polymarket, it's been alleged by the Wall Street Journal, has been putting out a whole bunch of viral content that the Wall Street Journal piece alleges was completely fabricated and untrue. What the article was putting forward was that college-age creators trying to potentially appeal to that age demographic were making bets that were basically false and being persuaded or being pushed towards attracting US-based clients. Now, why that's problematic from a legal sense is that Polymarket is not supposed to have US-based persons trading on it. So just in terms of like the ethos of the prediction market industry, transparency, bringing information in, sits very uneasily with this marketing trend to maybe push viral content that at its heart is just not true. And that really creates a problem for regulators as they look to get their arms around how exactly to regulate this marketplace.
Professor Yadav, I'm curious about the market integrity, and maybe it's not as big of an issue with the World Cup and more of an issue with so-called mention markets. But when you have so many players, Kalshi, Polymarket, Robinhood's Rothera, DraftKings, Coinbase, all getting involved in World Cup betting, who's responsible for market integrity across this landscape?
Tim, you're asking the now $10 billion question, which is who gets to regulate this market? And I'd push back gently on the notion that market integrity is maybe not as important in the World Cup scene. The financial stakes here are huge. There are market makers here, which are professional institutional market makers that are jumping into this market. And as you and Denitza and Scarlett were mentioning earlier, insider trading continues to be an issue, even in the context of the World Cup. So, for example, injury news, who the potential folks on the bench may be, who's going to start the lineup. These are all issues that can potentially be subject to knowledge that those in the locker room, those in the stand, very close to the action can get into. And so, market integrity does get implicated here, potentially in a hugely consequential way.
Yeah, I retract my point earlier, because all the things that you mentioned, I was only thinking about the score and just the outcome of the games. But but when you mention all those other things that can be predicted or bet on, you're absolutely right. There's the circle of who has knowledge or control of those things just gets bigger and bigger.
So, Tim, there are 400 contracts, more than 400 contracts just in a single prediction market alone, trying to reference any variety of outcomes, including things like, who is an injury candidate for a particular game. So these are potentially very problematic instances where regulators have to keep track of a deeply moving market and set of scenarios. Now, you asked at the very outset, who's going to regulate this? Well, the short answer is the CFTC is pushing to be the regulator for this market, but 11 states now are pushing back. And they're pushing back in a super hard way in a set of facts and circumstances that many commentators suggest will only be decided ultimately by the Supreme Court.
Yeah, I mean, if not the Supreme Court, maybe someone else. We're talking about $20 billion in monthly volume with World Cup bets, sports contracts, and crypto sports books all blurring together. I guess the distinction has kind of collapsed, and I wonder if Congress should just step in and perhaps regulate these as gambling platforms.
Well, you're asking a really deep question, Scarlett, which is, what is this thing? The CFTC is arguing that these are essentially a form of derivative event contracts. The states are pushing back to say this is sports gambling, this is our domain, this is what we're really good at regulating. But as you can see, Scarlett, as you just mentioned, the financial stakes now are huge. The popular stakes now are huge. The complexity is huge. And so in that context, everybody has real skin in this game to be the chosen regulator for this space. Now, the fact that sports has become such a big component of it and not presidential elections as it was, previously, amps up the level of controversy even more. And so it's really up to the CFTC to make the case for itself that in fact it is a designated regulator. These are in fact derivative contracts, and that it in fact has the capacity and capability to oversee what is now becoming a really mammoth and financially consequential market.
Yesha Yadav, professor of law and associate dean at Vanderbilt Law School. Yesha, always good to speak with you. Thanks so much for joining us. Well, coming up, the Bank of England softening its stance on stablecoin holdings for individuals. We'll discuss its newest policy proposal to entice retail traders next. This is Bloomberg.
We're just about halfway through the trading day in New York. I'm Nora Melinda. Let's take a look at your midday movers. First up, the market's biggest winners are turning into its biggest laggards as a sell-off in Asian chip stocks spills over into U.S. markets, weighing on tech shares and dragging down major indexes. Among the names to watch, SanDisk and Micron are leading the retreat in semiconductors as investors trim exposure to AI-related trades ahead of Micron's earnings report following Wednesday's closing bell. And elsewhere, AMC shares are plunging more than 25%, on track for their worst day since 2023, after the firm agreed to sell more than 95 million shares to institutional investors, raising about $200 million. And finally, FedEx is slipping ahead of its earnings after the closing bell, with investors focused on the company's outlook following the recent spin-off of its freight business. Those are your midday movers. I'm Nora Melinda.
It's time now for a token moment where we look at the efforts to tokenize different parts of the market. And here's a new one. Former New York Governor Andrew Cuomo starting a second act. He's helping cryptocurrency exchange operator OKX, as well as the owner of the New York Stock Exchange, build a new business merging digital and traditional finance markets. Part of the plan would be to allow overseas users to trade tokenized U.S. equities. Cuomo said it's going to be a very, very powerful combination. It's ICE and the New York Stock Exchange recognizing that this technology is coming. Bloomberg's Catherine Doherty is covering the story, and she joins us now. Does Andrew Cuomo have any prior relationship or history with cryptocurrency in the crypto industry?
Yes. So interestingly enough, he's been working with OKX, this company that is partnering now with the New York Stock Exchange since 2023. So this is not a new venture or company for him. This is a relationship that he has had. He's advised them on policy efforts, some investigations that the company has had with U.S. prosecutors, and he's really opening doors for both OKX and now in this joint venture with the New York Stock Exchange. He's going to be helping them establish relationships, answer questions when it comes to regulation and policy as both of these companies move forward with their business venture.
What's the product that they're building here?
So this is really twofold. You have OKX that is looking to access and go into a new jurisdiction in the U.S. So they're looking to establish a regulated venture, and for the New York Stock Exchange, they're establishing their own path in terms of tokenization, tokenizing stocks, and they're both using the technology that OKX is helping advise and build alongside the New York Stock Exchange. And then they're also going to be accessing all of these OKX customers that are now overseas, looking to bring them onshore through a regulated venue.
The Intercontinental Exchange part of this is really fascinating to me. This is a company that owns the New York Stock Exchange. It's based in Atlanta. Jeff Sprecher is somebody who you've spoken to quite a bit, Kat. It's got a market cap of $75 billion. He told you, you were there, like he was the upstart,
That's right.
30 years ago.
And now he's mainstream.
Now he's mainstream. He's working with these upstarts. Is he trying, is ICE trying to just, are they scared about what's coming at them right now?
In some ways, this is a defensive move. When you have companies like ICE, CME, you're going to see these huge exchange operators look for the newcomers and also look at the new technology that might upset or disrupt some of the business that they have been incumbents. They have been the established established large players. So they're looking forward. They're looking at a company like OKX. ICE also partnered with Polymarket. They're seeing prediction markets as another incoming stream of both new customers that they see, and for their own customers, you think the large institutions, the finance firms that might be looking at a Polymarket and the data that they are providing as a new stream of information. So it goes both ways.
All right, Catherine, fantastic context there. Catherine Doherty of Bloomberg News covering the fintech space, the market structure space for us here. All right, we have some breaking news, Tim, and this is about Meta, Mark Zuckerberg's Meta.
Yeah, Zuckerberg directed Meta to create a prediction markets app. This according to the New York Times. The app, according to the Times, would be independent of Facebook and Instagram. Again, this according to the New York Times. Mark Zuckerberg directed Meta to create a prediction markets app. You've got the story pulled up. I want to say it's not surprising in the sense of like Facebook as a core has always, speaking of defensive, has been very defensive about where to go next. And I think, you know, Instagram, that $1 billion purchase of Instagram
and they're
back in
not a
2012.
first mover either. They wait to see what works, and then they kind of swoop in and use their big balance sheet and buy other companies.
In any other timeline, it would be a challenging regulatory environment, but not in this one.
No.
Yeah.
Polymarket and Kalshi, of course, doing very well, and Mark Zuckerberg has noticed, and he basically wants in on the action. So dispatching a small team at Meta to create this smartphone app that's similar to Polymarket and Kalshi, according to the Times. Users would not wager money, and the app would probably rely on a video game-like point system instead. Great, just what parents need.
Yeah, okay, cool.
So we'll keep you posted on any further developments. Get predicting. All right, let's talk about the Bank of England and go overseas right now because it's introducing a temporary 40 billion euro cap on the issuance of each UK stablecoin, replacing plans to limit how much individuals can hold. Bloomberg's senior crypto editor, Anna Yadav, has been following this story and joins us now. And Anna, just put into context for us this idea that the Bank of England has introduced this temporary cap for the issuance of each UK stablecoin. Where are we at in this process?
So the Bank of England has been consulting on its stablecoin rules for systemic stablecoins, which would be the bigger ones, for quite some time, and it has been having a bit of a tussle with the industry in that originally it was planning to cap how much businesses and individuals could hold. And obviously providers of stablecoins were saying the caps were too small and would make it impossible for stablecoins to grow. So after a period of consultation on the rules, it's come back and it said, we're going to scrap these caps, but we're going to introduce a maximum issuance limit at the beginning for stablecoins. So it was welcomed by the industry because at least it looked like it was taking a step towards softening the stance, but it's still there's still elements where people are concerned that it won't make the UK as competitive as other markets, especially the US, on stablecoins. And it's interesting, you were discussing Facebook before and how it's getting into prediction markets. Let's not forget that it had been very aggressive originally on stablecoins and had come up with the Libra project, which was supposed to be a stablecoin. And that's kind of what led some angst and concern among central banks. And I guess part of the regulation now and the efforts of them looking into it comes from those stablecoin, Meta stablecoin days.
It's another great reminder, another example here of how Meta, not a first mover, but will definitely jump on something once it gains traction. And by the way, let me just correct myself. It's a £40 billion cap for the total issuance of each UK stablecoin.
Okay. Anna, you mentioned competition here and sort of how the UK is viewed in relation to the rest of the world, including the United States. Is that what this is about, making sure that they can attract talent and attract companies and attract commerce to the UK?
It's very much a geopolitical issue, actually, at the moment, digital money and stablecoins, right? With Donald Trump coming in the White House and being so supportive of stablecoins, which essentially are a way to push dollar dominance around the world and also promote, government debt, because stablecoins are backed by reserves of Treasury bills when they're dollar-based. Governments and economies around the world are really concerned that that means that if you're not keeping up, their own currencies might sort of fade in the digital era. And so we've seen the EU try to push, and the ECB try to push a digital euro, and proponents of digital money in the UK say we need to have an alternative. And if you're not going to do a digital pound, or that's still to be decided, then you need to let stablecoins be very effective, and if they're denominated in pounds.
All right, good stuff. Thank you so much. Senior crypto editor Anna Yadav of Bloomberg News in London. She is our go-to person for all things on crypto outside the world of the U.S. borders. All right, coming up next on Bloomberg Crypto, the Clarity Act is stalled on Capitol Hill. Our next guest says that even if it passes, it might not be enough for the industry. We'll have more on that. This is Bloomberg.
Time now for Political Exchange, where we track the intersection of DeFi and policy. A signature part of President Trump's crypto policy depends on the passage of the Clarity Act. But time is running out for lawmakers to pass the bill before the midterms. Wyoming Senator Cynthia Lummis tweeted over the weekend, software developers should not need an army of lawyers to know if their code is legal. The Clarity Act ends that absurdity. Our next guest says that even if the Clarity Act were to get passed, it may not be enough of a framework for the industry. We're joined by Ashely Ebersole, co-founder of RWA Infrastructure. It's a platform. He also served as senior counsel at the SEC. Ashely, good to have you on the program. What do you want to see in addition to the Clarity Act that would be enough of a framework for the industry?
Well, first, thanks so much for having me on. It's great to be here. I'm a shameless fan of Bloomberg, and it's a real thrill. But it's great to be here with you all talking about Clarity Act. I do think that were it to pass, we're running very short on time, but were it to pass, some notable exceptions are moving from a definition of what's a security, what's a commodity, who's the regulator, to how do you help assets move from the physical world to on-chain. And it doesn't do anything for that. That's the real trillion-dollar opportunity. That's what's going to help, honestly, legacy players like BlackRock, Apollo, DTCC. We're not there at this phase. I'm confident we will be in the near future.
The bank lobby has been pretty vocal in trying to slow things down and question almost everything in there. Have they watered down the bill enough to their liking? I mean, what did they get out of it at this point if it were to pass?
Well, the bank lobby fought hard against Genius Act, and they lost that one. So they really dug in and said, Clarity isn't going to become law. They're doing their best to run out the clock. We're getting close to sort of the drop dead date for that. As to whether provisions have been watered down enough, you would think so. They've done, a lot of work. Congress is unified behind this becoming law. It's just a question of if there's time.
What happens if there is not time before the midterms? I mean, we don't know what's going to happen in the midterms, but we could see a completely different composition of Congress.
Sure. Well, once you get past the August recess, yeah, to your point, a lot of attention, maybe all the attention, is going to turn towards re-election. And then this is what happened with Genius for a few years, if you recall. It always became, well, we might have it by recess. You didn't have by recess. Well, maybe by the midterms. No. Well, what about the lame duck? Maybe, but then it gets kicked to another year, and someone's got to reintroduce it. That did happen, and obviously Genius became law. It just wasn't in its the first year it was introduced.
As a former senior counsel to the SEC, what can the SEC do and not do before a Clarity Act is passed? I mean, is it in any position to get stuff ready in the meantime, or it can only really get going once this is signed into law?
Well, the current SEC and Paul Atkins is an absolute visionary who's moved the agency so far forward in terms of what it is willing to do in this regard to modernize markets. But yeah, to your point, they can only do so much, and they can only take measures that have a certain amount of permanency, not like legislation. They can issue notice and comment rulemaking proposals, they can issue guidance, but the SEC themselves is asking for, we need legislation so we can continue to build regulatory infrastructure around it and put out, our guidance on and regulations on how to implement that legislation. They're asking for it. Whether or not it happens, we will see. They can certainly do guidance. They can do rulemaking in the meantime. It just doesn't have the permanence.
Ashely Ebersole, co-founder of RWA Infrastructure, the platform, also former senior counsel at the SEC.
Yeah,
all right.
Thank you so much. Oh, sorry.
Oh, no. Thank you so much for joining.
You got to come back.
I'd love to be back. Love to tell you more about TX. Everyone should download the app.
We'll have more later on. That does it for our Bloomberg Crypto for this week. Be sure to tune in and check us out again next time. Same place. This is Bloomberg.